Welcome to cryptrex. If you are new to the channel, make sure you subscribe right now, because here you will find deep knowledge, strategies and guides that can change the way you see the world of cryptocurrency. Today, we're going to talk about one of the most exciting ways to make money in the crypto market, which is crypto arbitrage. Arbitrage is a concept that has existed in traditional finance for decades. But in crypto, it has taken on a whole new life because of the volatility, the large number of exchanges, and the opportunities that exist 24/7. Arbitrage is about taking advantage of price differences across different platforms and converting those small gaps into profit. When done correctly, arbitrage can become a consistent source of income. And today, I'm going to explain in detail how it works, what the latest strategies are, and how you can use them in practice. To begin, let us understand the basic idea of arbitrage. Imagine Bitcoin is trading at $40,000 on one exchange and at $40,500 on another. This price difference is an opportunity. You could buy Bitcoin on the cheaper exchange and sell it on the expensive one, instantly locking in a $500 profit per coin. The concept is simple, but in practice there are many details to consider, such as transaction fees, transfer times, liquidity, and competition. The essence of arbitrage is speed, precision, and access to multiple markets. The faster you can identify and execute the opportunity, the more money you can make. The simplest type of arbitrage is called spatial arbitrage. This means you are buying on one exchange and selling on another. The strategy requires you to have accounts and balances on multiple exchanges, so you can move fast. If you wait to transfer coins from one exchange to another, you may lose the opportunity because the market changes quickly. Professional arbitrage traders keep funds on both exchanges so that when they see a price gap, they can buy instantly in one place and sell instantly in another. Then later rebalance their holdings. This method reduces transfer delays and makes the strategy more efficient. Passes. Another form of arbitrage is called triangular arbitrage. This happens within a single exchange. It works when three different trading pairs create a loop of price differences. For example, you might start with Bitcoin, then trade it for Ethereum, then trade it Ethereum for USDT, and finally trade USDT back into Bitcoin. If the prices are slightly misaligned, you end up with more Bitcoin than you started with, without adding new money. This is pure profit generated from price inefficiencies. Triangular arbitrage is very popular among bots because the opportunities appear and disappear in fractions of a second. Human traders usually cannot move fast enough, but automated systems can take advantage of these gaps thousands of times a day. Statistical arbitrage is another approach. It uses mathematical models and algorithms to predict price movements and exploit tiny differences over and over. These strategies are often used by hedge funds and professional trading firms. They combine advanced software with high-frequency trading infrastructure to capture profits that most retail traders cannot even see. However, statistical arbitrage is becoming more accessible as crypto data tools improve and as cloud-based trading bots become cheaper and easier to use. P/end. Decentralized exchanges have also opened new doors for arbitrage. Opportunities often arise between centralized exchanges like Binance or Coinbase and decentralized exchanges like Uniswap or SushiSwap. On a decentralized exchange, prices are determined by automated market makers, which sometimes lag behind the centralized market. For example, if Ethereum pumps suddenly, centralized exchanges adjust quickly, but decentralized pools may still offer lower prices for a few moments. A trader who is fast can buy from the DEX and sell on the CEX or the other way around. This type of arbitrage has created massive opportunities for those who know how to use DeFi tools. One of the latest strategies in arbitrage is cross-border arbitrage. This is when traders take advantage of price differences between countries due to regulation, capital controls, or demand differences. For example, in some regions like South Korea, Bitcoin has historically traded at a premium compared to global prices. This is known as the kimchi premium. Traders with access to both markets can profit by selling at the higher local price while buying from cheaper global markets. This requires more setup and often involves legal and banking challenges, but for those who succeed, the rewards can be very high. Latency arbitrage is another cutting-edge method. It's based on speed. Some exchanges update prices slightly slower than others. If you have access to faster data feeds or co-located servers, you can trade on the slower exchange. Before it catches up, this is the domain of high-frequency traders who spend heavily on technology to get even a millisecond advantage. In crypto, where markets never sleep, even the smallest edge can create millions in profit when scaled properly. Another opportunity comes from futures arbitrage. Futures contracts are derivative products that allow you to bet on the future price of an asset. Sometimes the futures price is higher than the spot price. This difference is called the funding basis. By buying the spot asset and selling the futures contract, you can lock in a risk-free profit when the contract expires. This is also known as cash and carry arbitrage. Traders and funds often use this strategy to earn steady returns without taking on too much risk. It requires larger capital, but it can be one of the best, safest ways to earn consistent profit in crypto. Let us also discuss funding rate arbitrage, which is a variation of futures arbitrage. In perpetual futures markets, traders pay or receive funding fees depending on whether they are long or short. If the funding rate is very high on the long side, you can take the opposite position and earn funding fees as income. Professional traders monitor funding rates across multiple exchanges and place trades that benefit from these imbalances. Over time, this strategy can generate stable profits with relatively low risk compared to outright directional trading. Bots and automation have transformed arbitrage into an industry of its own. A manual trader cannot watch all exchanges all the time, but a bot can connect to dozens of exchanges simultaneously, scan price differences in real time, and execute trades instantly. This is why most serious arbitrage operations rely heavily on custom-coded bots or platforms that offer ready-made solutions. Some even run their systems on servers located physically close to exchange data centers to reduce latency by microseconds. Every small speed advantage counts when thousands of traders are chasing the same opportunities. Liquidity pools and yield aggregators in DeFi have created new arbitrage styles. For example, you can provide liquidity to one pool, then use flash loans to borrow large amounts instantly and exploit price differences without putting up your own capital. Flash loans are unique to DeFi and allow traders to borrow millions of dollars for a few seconds, as long as they repay the loan in the same transaction. Arbitrage with flash loans has generated huge profits for skilled coders who know how to design the transactions correctly. This strategy shows how crypto creates opportunities that never existed in traditional finance. As with all opportunities, arbitrage is not without challenges. Fees can eat into profits very quickly. If you are paying high withdrawal fees or high trading fees, small price differences may not be worth it. Transfer times also matter because the crypto network itself can sometimes be slow. If you try to move Bitcoin from one exchange to another, you might wait 30 minutes, which is too long in arbitrage. That is why experienced traders keep funds pre-distributed across exchanges, so they can strike instantly when opportunities arise. Security is another important factor. You must trust the exchanges and platforms you use. Hacks and failures do happen, and funds can be lost. That is why diversification across multiple trusted exchanges and secure wallets is recommended. Arbitrage also requires careful accounting, because moving funds across borders or between platforms can have tax implications, depending on your country of residence. This is why professional arbitrage traders often consult with accountants and lawyers to stay compliant. Despite the challenges, arbitrage remains one of the most reliable methods of making money in crypto. It's not gambling or speculation. It's about exploiting inefficiencies in the market and turning them into profit. Market grows, the more opportunities appear, especially with the constant rise of new exchanges, new coins, and new forms of trading. Arbitrage rewards discipline, research, and the ability to act faster than the competition. In this session, we've only scratched the surface of what is possible with crypto arbitrage. We've looked at spatial arbitrage, triangular arbitrage, statistical arbitrage, decentralized exchange opportunities, cross-border arbitrage, latency-based methods, futures arbitrage, funding rate strategies, and DeFi flash loans. Each of these can be expanded into its own full strategy with detailed tools, examples, and case studies. As you continue exploring, remember that the key is not just finding the opportunity, but executing it safely, quickly, and profitably, efficiently. Thank you for spending your time with Cryptrex today. I hope you found this guide valuable and inspiring. If you're serious about crypto arbitrage and other strategies, do not forget to subscribe, because we are just getting started. Here on Cryptrex, we will continue to share the latest updates, professional insights, and practical guides that can help you grow in the world of digital finance. This is Cryptrex signing off until the next video.